So we're going to take a look at performance attribution for 2024. This shows us the breakdown of the gross return of the total return fund versus the index. And we break it out by the return in relation to changes in spread, changes in the interest rate curve, and the carry on the portfolio. So our excess return, most of it came from carry. You can see about 176 basis points of excess return in relation to just earning more coupon and yield on the portfolio. A decent amount of spread tightening, more so than the index, which has only about a third of it in corporate bonds, some securitized credit. And a little bit about performance related to the curve. We had a 230 steepener on, and we were carrying slightly shorter duration, and rates rose into the end of the year. So a great year for total return in 2024. We started off the year with many of the assets we hold inside, securitized assets, things like agency, mortgage-backed securities, non-agency, MBS, CMBS, asset-backed securities, CLO, all kind of had lagged the corporate credit markets in 2023. So it was a good setup for those assets to catch up. The credit in the fund did about 7 to 8%. Versus corporate bonds doing in the low 2s last year. High yield was up about 8. And so really it was a story of credit doing well last year. Agency mortgages lagged the credit markets, but started playing catch up towards the end of last year, and they're starting to shine in 2025. So as we look at year to date through Feb 28th, a lot has happened since Feb 28th, but that's where we have this data through. You can see the index having almost no spread tightening because, as Jeffrey showed, spreads tightened to start the year but have widened with this volatility. Yet the total return portfolio, already 38 basis points of return in relation to spread tightening. Both the credit and also agencies are catching up. Agencies are finally catching up as rates fall. Curve return, we're slightly shorter than index, so index doing a little bit better from a duration standpoint, but we're making it up with carry. You can see the carry return, 26 basis points more so than the index. And this is through Feb 28th. If we go through last night, we're just a little inside of 50 basis points ahead of the index on a net basis. So I think a lot of that has to do with mortgages outperforming corporates. Taking a look at some metrics on the portfolio at the top left, you can see our duration slightly shorter than the index, which we like right now. We've had a pretty decent rally here. Seems like the bond market's stalling out a bit. Wouldn't be surprised to see a little bit of a correction there. Yield to maturity, still 100 basis points of excess yield versus the benchmark. That's going to help generate that carry return relative to the index, and carrying an A+ rating weighted average on the portfolio. We still have a very large core holding in government guaranteed agency mortgage-backed securities, Fannie Mae, Freddie Mac, Ginnie Mae securities. You can see that's about 51% of the portfolio. The yield is, a lot's happened in March, but the yield is almost about the same. I checked right before this webcast, it's in the low to mid 5s. Duration of about 5 years, sitting at the belly of the curve. And then our credit, which is about 43% of the portfolio, still has an attractive yield of low to mid 6s, which is about 100 basis points more yield than investment grade corporate bonds. Our credit quality is still very high. I've got some slides to show that a little bit later, but we still have a very healthy exposure to the non-agency RMBS sector. That's about 25%. Many of these securities were bought many, many years ago, so they have a lot of seasoning. A lot of home price appreciation has occurred over the last 10, 15 years since we launched the Total Return Bond Fund. And so there's a lot of safety in the seasoning of these loans. These borrowers have now been in their homes for many, many years, have seen prices of homes go up, have been making their payments. And we think that it'll be, the portfolio will be very resilient even into a weakening economy, especially since mortgage servicing has improved dramatically since the global financial crisis. We saw that in action during COVID when we enacted mortgage forbearance programs. So all those things we think are a good fundamental backdrop for the credit performance of these assets. And housing, as we've seen, even with rates higher, has been resilient thanks to the lack of inventory. We haven't built enough homes in the U.S. over the last 10 years post-crisis. CMBS, next largest holding, 8% of the portfolio, less than 2% in office in the CMBS book. And rates falling is good for the CMBS market. We're seeing a huge pipeline of loan origination coming in the CMBS market. It's going to be packaged up into bonds and sold. What that is are borrowers that are potentially in old CMBS deals that we own and bought in the years gone by. And now that rates are lower and the market's opened up, they are going to refi. So there was an expectation that there was going to be this continuous extension of loans in the commercial real estate market, being hard for borrowers to refinance. But with the bond markets kind of open back up and rates lower, that's going to be really good for the performance of many of the assets we have, getting cash back that on bonds that maybe we thought were going to be around for longer. So it seems like the commercial market has found a bottom here. There's still obviously challenges with office buildings, but other parts of the market have kind of found a floor in valuations. If you looked at index of commercial real estate prices, it's off the lows here, and the light I think is at the end of the tunnel when we talk to Morris Chen and the rest of our CMBS team. Asset-backed securities now almost 6% of the portfolio. Had some good performance last couple of years. Short duration asset with excess yield over investment grade corporate bonds into a rising rate environment. It's been a good place to be. It's been a market that continues to grow and develop with new sectors, and we're excited about opportunities there. We actually have been increasing ABS. It's one of the places we added to last year. And CLOs we added to last year. It's about 5% of the portfolio. It's done extremely well because it's floating rate on a backward-looking basis. We're actually potentially looking to take advantage of some tight spreads there and decrease our floating rate exposure in the portfolio. So it's a little summary on different pockets of the market and different parts of the total return bond fund. But let's look at some of the changes that we made year over year that I think are interesting. So on the top left, you see our exposure in the agency mortgage portfolio. It went down a little bit. Some of that was just market value movement. But the big change really is in the pass-through, the CMOs. Pass-throughs are your generic mortgage-backed securities where you just receive the principal interest that comes from the mortgages that are inside the securitization. And CMOs are collateralized mortgage obligations where Wall Street now structures them and tranches them into different types of bonds where you can get your cash flows at different times. And there's certain periods of time when CMOs are cheap. In 2023, when you had a bunch of banks go under, there was a lot of selling of CMOs. So we actually increased CMOs in 2023. But with those bank failures in the past and volatility coming down, the spreads tightened pretty dramatically on CMOs. So we've been, across all our funds and separately managed accounts, we've been reducing CMOs. You can see they're down about 5% and adding to pass-throughs, which were cheaper, more liquid, and an interesting trade to do there. So that's one of the changes in the agency portfolio. Also, treasuries came down as we bought some more mortgages in the wider spread environment that we saw last year. Spreads have come in since then. So that's kind of one of the main changes between the different pockets of the MBS universe. There's also different coupon bonds you can buy. And with the wide spreads that we saw, we've also kind of been moving up in the coupon stack. So you can see we about 20% of the portfolio has transitioned to higher coupon mortgages, which we see as having better relative value, more spread, and think there's some room for spread tightening, which has kind of played out this year already. So that's the agency mortgage-backed securities book. On the top right, you can see the changes I briefly talked about earlier. We were getting a lot of pay downs by deals getting called in the RMBS space. And so we took a little bit out of RMBS, we took a little bit of agencies, and we added to CMBS, ABS, and CLOs last year. Kind of around mid-year last year, there was a robust pipeline of transactions coming to market. And we felt that with corporate credit spreads having tightened a lot, that these bonds just looked too cheap and would tighten spread and play catch up with the corporate credit markets. And again, that played out last year, and it continues to play out this year, taking a little breather with this equity volatility, but we still think there's relative value there. And then lastly, credit quality has gone up. The credit curve, as Jeffrey showed in one of his last slides, looking at the difference between higher quality and lower quality assets, has flattened. So you just don't get paid as much to go down in credit quality. And in that kind of environment, the thing to do is go stay up in quality. So you can see that this is the ratings of our credit has gone up. More investment grade bonds. In fact, the weighted average rating of the portfolio is now single A plus. A year ago, it was single A flat, and a year prior, February of 23, it was single A minus. So we've gone up almost an entire rating notch in the quality of the portfolio, as all teams have been kind of upgrading quality, given that spread tightening. But also, rates are so high now that you can stay in high quality assets. You can get a lot of attractive yield out there. Looking at credit quality, the slide's been in the presentation many times before, just showing you the delinquencies in the red and the amount of either credit enhancement, meaning bonds that need to take a loss below you, or just discount that we have. And so a lot of cushion and safety, a very high quality credit portfolio. We're not taking a lot of credit risk in the total return fund. So we feel like it's going to be pretty resilient to a weakening, potentially weakening environment. Duration has come down a bit, still a little bit short to the benchmark. We feel that's prudent just given the rally here. We'll reassess if we see rates back up again. And you can see it's close to the longest duration we've had, just given rates are the highest they've been since we started the total return fund many years ago. And we want to have that duration positioning. However, we want to be underweight the long end. Due to fiscal concerns, we have a 2s 30s steepener on here. So you can see we're overweight the 2-year and underweight the long end, which has kind of been working. It worked well last year, stopped working for a little bit towards the end. But we think we want to continue having that position on, and we have that across many of the different strategies that we run at DoubleLine. And lastly, looking at valuations, this is updated through the end of last week. This shows you a percentile rank. Basically, the lower the dot, the more expensive the sector. These dots are actually off their lows. Many of these were first percentile, like IG Corps and high yield at one point got to first percentile, meaning only been richer 1% of the trading days over the last 10 years. But with a little bit of volatility and spread widening, they're looking a little bit better. But still nothing like the securitized sectors. I've circled them up in the top left. Agency mortgages, almost 80th percentile. So many of the things that we own in total return, they've done well last year. They're doing well this year, but from a valuation standpoint, they definitely are on the cheaper side relative to corporate bonds. It had a terrific run, but we think that these attractive valuations are compelling for investors. So thank you for your time.